The recent 50 basis point cut by the Fed is a clear signal of their commitment to preemptively address downside risks in the economy. This move reflects a proactive stance to safeguard the labor market, emphasizing their intent to prevent any further deterioration in employment figures. While this approach is undoubtedly positive for job growth, it raises concerns about inflationary pressures. Lowering rates can stimulate spending, but if demand outpaces supply, we could see inflation creep up. Financial analysts must closely monitor these dynamics, as the balance between fostering employment and controlling inflation will be crucial in the coming months. Understanding this interplay will be key to navigating the evolving market landscape. The recent decision by the Federal Reserve to cut its policy rate by 50 basis points marks a significant shift from the usual 25 basis point adjustments we've come to expect. This larger-than-usual cut signals a proactive stance in response to economic pressures, but the Fed has made it clear that such measures won't become the norm. Looking ahead, the median projections from the Federal Open Market Committee indicate an additional 50 basis point cut could be on the table over the next 2 meetings. This suggests a cautious approach, balancing the need for stimulus with the risks of inflation and economic overheating. As we analyze these developments, it's crucial to consider the broader implications for market dynamics and investment strategies. The Fed's actions will undoubtedly shape the economic landscape in the coming months, and as financial analysts, we must stay vigilant and adaptable. Recent projections reveal that only 9 out of 18 members anticipate cutting interest rates by an additional 25 basis points or less before year-end. This suggests a significant shift in sentiment among policymakers. The data indicates that many members are likely not considering a more aggressive 50 basis point cut at the upcoming September meeting. This cautious approach reflects a broader concern about inflationary pressures and economic stability. It's crucial to analyze how this conservative stance may influence market expectations and investor behavior. As we navigate these economic waters, understanding the nuances of these projections will be vital for forecasting future monetary policy decisions. The recent September meeting of the Federal Reserve has significant implications for our economic landscape. Chair Jerome Powell's persistent warnings about rising unemployment appear to have resonated with committee members. This suggests a strategic pivot towards a more aggressive monetary policy. Instead of a modest interest rate cut, we're likely looking at a substantial reduction aimed at preemptively addressing potential downturns in the labor market. This decision reflects a growing consensus that the risks of inaction could outweigh the benefits of a cautious approach. By acting decisively, the Fed aims to bolster economic stability and mitigate the adverse effects of unemployment before they escalate. The stakes are high, and the implications of this meeting will be felt across various sectors of the economy. The labor market is poised to dictate the trajectory of monetary policy in the coming months. As we observe the Federal Reserve initiating an interest rate cutting cycle, the uncertainty surrounding the future policy rate is palpable. We must consider the implications of Jerome Powell's leadership. He is acutely aware that any further deterioration in the labor market is unacceptable. The Fed's decisions will hinge on employment data, which means that job growth and wage stability will be critical indicators. If the labor market shows signs of weakness, expect Powell to act decisively to bolster it. The interplay between labor dynamics and monetary policy will be crucial as we navigate this complex economic landscape. The stakes are high, and the Fed's response will be closely scrutinized by economists and analysts alike. The unemployment rate is poised to become the most critical macroeconomic indicator in the upcoming months, especially as the Federal Reserve navigates its interest rate decisions. If we see a continued upward trend in unemployment, the Fed will likely act swiftly to ease monetary policy. A cut of 50 basis points could be on the table, rather than the more conservative 25. This shift would reflect a proactive approach to stimulate economic growth and counteract rising joblessness. Understanding this dynamic is crucial for us as economics students, as it highlights the intricate relationship between labor markets and monetary policy. Keep an eye on those unemployment figures. They could shape the economic landscape significantly. The latest interest rate projections reveal that the median committee member estimates the neutral rate at approximately 2.9%. This range, spanning from 2.4% to 3.8%, indicates a significant divergence in perspectives. What's particularly striking is the implication that the committee believes there's still around 200 basis points of room for rate cuts before we hit that neutral level. This suggests a cautious approach moving forward, as members weigh the balance between stimulating growth and controlling inflation. As we analyze these projections, it's crucial to consider how they might influence market expectations and economic behavior in the coming months. The dynamics at play here are complex, and understanding them will be key for economists and financial analysts alike. The Federal Reserve is navigating a delicate balance, aiming for what they call a soft landing. Their projections suggest we're in for a gradual slowdown in economic activity, which sounds daunting but could actually mean moderating inflation. The Fed anticipates only a slight uptick in unemployment, just 0.2 by year-end, before it begins to trend downward again. This isn't just about numbers, it's about stability. If they can pull this off, we might avoid the harsh impacts of a recession while still keeping inflation in check. It's a tightrope walk, but if the Fed's strategy works, we could see a more resilient economy emerging from these turbulent times. The Federal Reserve is navigating a complex landscape, anticipating a gradual economic slowdown without a corresponding rise in unemployment. This sets the stage for a series of interest rate cuts, for consecutive reductions of 25 basis points each, totaling 100 basis points by March. However, looking beyond that, the Fed's projections indicate a more cautious approach to rate cuts, largely due to uncertainties surrounding the neutral rate. For investors and traders, this means we should brace for a potentially volatile market as the Fed balances its dual mandate of fostering maximum employment while ensuring price stability. Understanding these dynamics will be crucial for making informed decisions in the coming months. We believe the likelihood of a scenario where rising unemployment triggers an economic recession is lower than commonly perceived. However, we also anticipate that the economy will not decelerate as sharply as the Federal Reserve forecasts. Our analysis suggests that the neutral interest rate hovers around 4%. If the Fed were to cut rates beyond this threshold, we risk overstimulating the economy, potentially igniting a resurgence in aggregate demand. This could undermine the progress we've made in curbing inflation. It's a delicate balance. While we must remain vigilant about unemployment trends, we must also consider the implications of our monetary policy decisions on inflationary pressures. The financial market is grappling with a significant expectation problem. On one hand, we have stocks soaring to historic highs, signaling robust optimism about future corporate earnings and profits. Investors seem convinced that growth is just around the corner. Yet, in stark contrast, the bond market is sending a different message. Interest rates have plummeted to unprecedented lows, indicating concerns about falling inflation and a slowdown in economic activity. This divergence raises critical questions. Are stock investors overly optimistic, or are bond investors too pessimistic? The reality is that these two asset classes are reflecting fundamentally different economic outcomes, creating a complex landscape for us to navigate. Understanding this disconnect is essential for anyone looking to grasp the intricacies of today's financial environment. Interest rates are at a critical juncture. It's challenging to envision them falling significantly without triggering economic deterioration, which would spell trouble for stocks that thrive on a robust economy. Conversely, stock prices are already hovering near historical highs, reflecting this strength. For stocks to climb further, we would need to see economic re-acceleration from this already strong base. The current landscape suggests a delicate balance. Sustained growth in stock prices seems unlikely without a corresponding boost in economic activity. Investors must tread carefully, as the interplay between interest rates and stock valuations could dictate market movements in the near future. Today, we find ourselves in a unique economic landscape. While the economy is indeed slowing, it continues to grow, and yet, inflation remains stubbornly above the Federal Reserve's 2% target. This creates a paradox where stocks seem overly optimistic about future growth, while bonds appear excessively pessimistic, reflecting fears of falling inflation and a deceleration in economic activity. Investors need to consider that solid economic conditions, despite the slowdown, suggest that we might be mispricing risk. The current bond market may be signaling a recession that isn't necessarily on the horizon, while equities could be riding a wave of optimism that overlooks potential headwinds. In this environment, a careful reassessment of asset allocations is crucial. Balancing between the cautious outlook of bonds and the exuberance of stocks could provide a more grounded investment strategy. Understanding these dynamics will be key to navigating the complexities of today's market. The expectation problem surrounding the US dollar is at its peak, as evidenced by its recent decline to the weakest level in over a year. This situation raises critical questions for investors. Despite the prevailing sentiment, I believe the negative outlook on the dollar is overdone. The fundamentals suggest that without a significant economic slowdown, we could be on the brink of a bullish reversal. Rising interest rate differentials are a key factor here, making the dollar more attractive relative to other currencies. Additionally, in periods of market uncertainty, we often see a flight to safety, with the dollar benefiting from increased demand. As we navigate these turbulent waters, it's essential to keep a close eye on these dynamics. The potential for a stronger dollar is not just a possibility, it's a scenario that could reshape investment strategies in the months ahead.